Hello YouTube, Justin here. This weekend we're going to try to find out whether or not we're repeating the stock market crash of 2008 because when I look at this chart, oh man, does it match up, and it looks quite similar. So the saying is, history does not repeat itself, but it rhymes. And when we look on the left, we got 2008. When we look on the right, we got 2022. I'm noticing a very similar pattern. I'm talking about the falling wedge right here. We have a falling wedge in 2008. We have a falling wedge happening in 2022. And what's very notable about this as well is that we also have a head and shoulders pattern where we reject off the right shoulder, the exact same thing we have setting up here in 2022. I would also note that we have a very important area right here where we reject off the 50 weekly moving average. So if we are repeating, what can we do to be prepared? Because if this is the start of the drop, we note here that in 2008, if we're repeating right now, we're only down here by about 20%. Isn't that what the stock market just did? Just briefly entered bear market territory? Absolutely. And this ultimately led to a decline of 50+% in 2008. So as we look forward here to our next chart, we've got the NASDAQ on the left-hand side and we got the S&P 500 on the right-hand side. We notice that exact same pattern setting up here where we have that falling wedge. So what is a falling wedge and why do we care about it? A falling wedge is generally going to be a bullish pattern. We can note here that we go down in a funnel lower with progressively lower highs and lower lows until we hit the apex or where the two trend lines meet. And if we are going to get that bull break, what we would be looking for would be a break of the trend, a back test, and then an advance higher. And the reason why I find this so interesting is because if we're going to repeat this, where will we get to? Well, the first thing we're looking at here on the NASDAQ and the S&P are going to be the relative lows, because looking here again, we're looking to form, let me just make sure I'm not jumping too forward. Looking at the pattern here, I mentioned this on Thursday, it roughly forms an inverse head and shoulders where we have the left and right shoulder roughly aligning. So this is important because we're now being told that we have a textbook bullish pattern if we can break higher, back test, and then advance. If that happens, I'm going to be believing it. I think we're due for a bounce, but we need to see the technical price action to confirm it. So for me, the attempt is going to start here where if we are forming a inverse head and shoulders, what needs to happen? Well, we pretty much have to make it back to this relative low. And the only way that we can get there, and I'll just make the colors a little bit different so it's a little bit easier for us to follow along. Green, right? We like green. Yes, Justin, we like green. So now as we look here, what would need to happen is, we would have to form the W, we would have to overshoot to the upside, back test into here, and then we can form that inverse head and shoulders pattern. So now that we have the framework for the technicals lined up, I'm now going to explain the reason why this is so important for us going into this next week. I'm actually going to flip to here where we can note that, yes, we are in a bear market. Everyone's talking about it, bear market 2022. The S&P technically did not close inside of correction territory, bear market territory by being below 384, but I'm noticing some things that are starting to get me a little bit concerned here. Notably, we have a repeat of 2008, as I just mentioned. We also have 7 red weeks in a row. So seven red weeks in a row is historic. Even back to 2008, all we had, again, back to back, 1, 2, 3, 4, 5, 6. In 2022, now we have 7. So there has not been a period, at least since about 2000, where we have 7 back-to-back red weeks where we close lower than we opened. In 2011, there is a brief period where we closed red, but we actually closed higher than we opened the week. So not to confuse things, again, we are repeating 2008. This is also still an orderly decline because we note that the S&P 500s, and again, so S&P closed out at 389.6. QQQ was at 288.6, off by 1 point on monthly expiry. So this is still orderly. So that's a big question for me. Next thing I want to look at here is just going to be the volume drop off. So in the summer, we have something called the summer lulls where volume generally drops off, but there's something very important here. It's notably the lower note here. It's supply and demand pockets. So what I mean by that is when we look here to the S&P 500, we now have the chart we looked at before, and this right here is going to be showing us, again, -10 off the high is going to be the blue line, -20 is going to be the green line, and then -30 is going to be where we see the previous 2020 top. When I'm talking about the supply and demand pockets, what I'm talking about is where the volume is. And as we can note here, by looking at the volume profile, we have, we have a really big range here in terms of supply. And then over here, we have a really big pocket of demand. And where are we right now? We're in no man's land. We have a bar right here, but the big bars are notably around here at about 428 or down here at about 330. So we're hanging out in no man's land right now, which means we're kind of due for a bounce. And this is really important for me because if we're going to repeat the pattern, we're probably going to come back down to the supply pocket. And that is how we repeat 2008. We come back down to here. So next thing I want to look at is going to be this next chart here, which is actually going to be a yearly chart. And what's so important about here is just that, again, we look back to, are we repeating 2000 or 2008, or are we doing something different? So on the left-hand side, now we have S&P, and on the right-hand side, we have QQQ. And what I want to point out here is something that is super, super simple, but it's only evident if we zoom out to a yearly chart, which means that every candlestick now represents 12 months worth of data. What we note here on the S&P, I'm just going to keep it hidden just because I got all these notes on here and it's going to get it a little bit funky. But if we look here at the current period here for the S&P, let's actually just look at this one specifically. What we note here is that we have, the high last year, 479. Here we got a basically 90-cent higher high, but we have a higher low. And that's really important because if we are repeating 2008, we should wash out. What does that mean? We should get this, this recession or this drop in 1 year, get it out of the way. So in 2008, we can note here that once we lost the 2007 low, oh boy, did it start to waterfall. And we haven't lost that area yet. So if we go to a log scale, again, it's now obvious that, whoa, this drop is starting, but that bar is not nearly as big as what we saw here in 2008. So as long as we maintain last year's low at 364.82 or roughly 365, I think that maybe we're repeating 2000, not 2008. I still think that 2008 is the base case here, but notable here that we had a big expansion, and in 2000, we actually saved a low. We saved the drop lower until the next year. And again, a lot of people are talking about a recession coming in 2023. What would that mean? It means that maybe we are repeating 2000, not 2008. I think we're going into a big correction. I'm just not sure which template we're using here. And again, history does not repeat itself, but it rhymes. And when we look here to the next chart, which is QQQ, we have a little bit of a warning here. And the warning is that we have already lost last year's low. So this low right here has already been lost. That's at 297.45. And until we reclaim that, we're currently in no man's land because we've lost the 2020 high. We are below last year's low. And the reason why this is notable is because going back to 2000 here, we actually saved the low. Again, just like on SPY, we saved the drop for the next year. For us, that would correspond with 2023. When we look to 2008, which is this period right here, what's notable is that, again, we got the drop out of the way. And going to a log scale, right now it becomes a little bit easier for us to actually identify that pattern where this drop is violent. Same thing in 2008. So until we actually lose the low, again, on SPY, specifically on SPY, I'm thinking that maybe we're repeating 2008 and not 2000. So with that in mind, now I want to talk about one next thing here. So this is something we talked about last weekend. I just want to read it really fast. So while equities have slumped, paralysis rather than panic best describes investor positioning. And only for every $100 into the market so far, only $3 has been redeemed. So I'm now going to start closing out some of these windows because we don't need them anymore. And I'm going to stick here because this is what I want to talk about next. So we now talked about the falling wedge. Generally speaking, what was resistance should now become support. So this area that we formed here in 2021 is where we're trying to carve out a bottom, right? Keyword there being trying. And if now we think about that supply zone, again, where are we? Well, again, that $1.1 trillion flowed in here at 428. And that is almost exactly where we have this lower base of supply here. So it's very important because I'm now going to close this out. And as we look forward here to our next chart, I was looking at ARK and the psychology chart. And what I was thinking about this week was if we're truly going to be going into a collapse, we need to see the last dominoes fall. That includes Tesla, Apple, S&P. So over here, now what I'm noticing is that, oh boy, does this look similar. This looks very, very similar to me. So on the left-hand side, we have the S&P 1-month chart. On the right-hand side, we have the psychology chart. And again, I have a color-coded and a few different lines here for us just to get an idea as to whether or not our emotions are getting the best of us and whether the price action can tell us what's actually happening. So now we're going to close this out, and we've talked about this already. I'm going to look at one more note, and then we're going to look at the charts to try to explain what's happening. This is from Mike Novogratz, and again, crypto is important, so alts or altcoins are already down 80% from the highs. In 2018, it was over 95%. That is down another 70%. My point is, picking bottoms is dangerous, and if you do, scale in slowly. So again, he corrected himself here, 2018. And again, I'm talking about the potential for us to go even lower. And this is notable to me because we have to remember this takeaway that we talked about before. Again, if we have another 70% downside from here, again, if we have that downside, be careful, because if you pick the right bottom and we actually start reversing, there are potentially hundreds of percent gains to capture back on the upside. So let's just keep that in mind. And as we go back here now, let's close this out. And we talked about the falling wedge, so I'm going to close that out too. We've talked about how if we're going to repeat the pattern, it pretty much has to start right now. And now what we're going to look at is going to be, oh no, I think I closed out the wrong one here. So let me just see whether or not I actually made a mistake here. Maybe I did. 1 second. I think I might have actually closed out the window I meant to keep open. So let's go here. Let's go to SPY. Let's go to our 1 month. Here we go. Got it. All right. So now what we have here is going to be, let me just close out some windows here so we don't get confused. We talked about this. That's out of the way. This one here, I'll keep open for now. So just looking here, again, we're currently at the the area here where we have the circle and the 50 weekly moving average. And what this ultimately did was give us a muted bounce, but it was actually for quite some time. And then we ultimately went lower. Same thing is setting up here where, again, if we're going to get a bounce, if we're going to go lower, we're probably going to be getting that to start happening pretty soon. Also in 2008 here, just before we move forward, what's really important is that the technical analysis is going to really help us, because as we look forward to the period here, again, we start actually going up, right? Low, higher, low, and then we got higher lows. We formed that lower low. So we were going down, we were going sideways. We started going back up, and then we stalled out. And when we stopped going up, just like here, where again, lower lows led to what? That's where the big drop happened. Once we got one weekly lower low, then it followed by many more. Same thing that happened here. Low, lower, 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 lowest, there's the drop. So I'm going to look at the technicals, and then I'm going to give you the reason why maybe we're going to be going down. So now we're going to snap this to the right-hand side, and I just want to walk through what this would mean, because this is a monthly chart, and we're set to close out the monthly candle, not this week, but next week. And this is important for me because we are now post-OpEx, and I think that we have to pay attention to the pattern here. If it's going to repeat, we only got so many days left. So what's important here, first of all, is that we have these pink lines here, which pretty much go back to the start of the rally. It forms a megaphone. And ultimately, where do we come back down to? Well, we test the lower range of the megaphone. Well, I want to show one more thing here just because I think it's really important. And let's go back to the 2008 example. We can now look here, and I want to just walk through this one versus here. So there's our falling wedge, which is pretty much what we're forming right here. There's the dead cat bounce. Doesn't quite make it up higher here, but we're looking for a lower high, right? There's the high in the dead cat bounce. There's the lower high. And now when we get down into here, what do? Well, we form progressively lower lows. 1, 2, 3. What do we have setting up over here in 2008 on the S&P 500? Oh man, Justin, don't tell me. 1, 2, 3. And then we go into what? A depression, a disbelief rally. And that is when the market starts going sustainably higher. So textbook 101 psychology chart in 2008. And I am not hearing enough people talking about how we have more downside. Everyone's like, oh, the bottom's at 30%, bottom's at 20, bottom is in, blah, 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 blah. I'm looking at the charts. I don't care what people say. I want to see what they do. So again, one more time, if we are repeating 2008, Do we have evidence to support our thesis? Well, once we break through here and we start going down, then we get what? Progressively lower lows. We got the 1, the 2, the 3, the depression rally, and then the disbelief rally for us to go higher. Exactly what's set up here on the psychology chart. So we have to make sure that we understand that this is very important if we want to be properly prepared for the next move. So again, one more time, what does that mean? Oh boy, we're maybe even heading all the way down to here. What is what? Oh man, don't do that. Do not tell me that. Well, again, what I've been talking about from the beginning of this bear market, so, right, negative 50%. Where does this take us down to? Somewhere in the 200s, low 200s, maybe even lower. Oh man, that's depressing. Yep. And we do have our 200 monthly moving average here, which is the black line at 205. And we also have our 50 monthly moving average, which corresponds with our 2020 top here. So this is a very strong demand zone where people are going to want to buy here. We've talked about this before. We have our bear market targets. We'll go through that in a moment. But anyways, jumping to here. So now we have to look at, okay, overall, does this look quite similar? I would say yes. What's really important to me is just this area right here too. 1, 2, 3. So here we have our high. There's our blast off, right? That's where we start to have the blow off top. And now we're retesting the trend line. That's what we're doing over here. So we've retested the trend line. We're trying to form a local bottom, relative bottom, short-term bottom, whatever you want to call it. We also note that here we have the head and shoulders. Here we got the head and shoulders. On this bounce, last thing I want to point out here, we also have progressively lower lows. 1, 2, 3. Back here to the psychology chart. Now looking here at the S&P, what do we have? 1, 2, 3. It's like it's almost repeating itself. Yes, it's almost repeating itself. And finally, we got the green line right here, which is where? It's roughly where we form our second high at optimism. And that's where our 50 MA is going to be aligning. So if we are going to dead cat bounce and ultimately come back down, this is where I would expect we're going to find some relief. And that is where we decide, are we going to have another dead cat bounce, reject on this low, and ultimately head down to 200s? Or are we going to actually start reversing here? And I'm going to walk through what I think would lead to a drop and what I think would lead to a rally. I'll go through that in a couple of minutes here, so just stay tuned. And if you're enjoying the video, I would really appreciate a thumbs up. I put a lot of time and effort into this video to make sure that it's packaged up, it's easy to watch, and that you're getting value as takeaways here. So finally, just talking about where we are right now. If we're currently in this period here, again, if we're going to bounce, I think, again, keyword being think, I don't know. I think we can bounce potentially as high as 450s. Again, keyword there being potentially. When we looked at the 2008 pattern, it was a micro dead cat bounce, which means that maybe you only make it to about 415, maybe 420, maybe a little bit higher. All right, so now that we got all this stuff out of the way, let's start moving forward because I'm aiming for this video to be a little bit shorter. I always say that, but this week I'm really hoping I can get it done. Talked about the falling wedge, talked about the psychology chart, talked about this, talked about Mike Novogratz. And again, he was invested in Luna. So when he says there's more downside, he just lost a lot of money. All right, now let's talk about the Fed. So we're going to talk about the Fed. And the reason why this is important is because we have to think about what is neutral for the Federal Reserve. Neutral meaning this is where they've been saying they want to be by the end of the year. And again, this is from Google. So just Google FOMC, neutral rate. This is what I got. Roughly 2.4%. That's why Powell and other officials have said in recent weeks that they want to raise rates expeditiously to a level that neither boosts nor restrains the economy, what economists refer to as the neutral rate. Policymakers consider a neutral rate to be roughly 2.4%. So if we're going to get to 2.4% by the end of the year, how do we get there? Well, I've done some math for you. I know people don't like math. I went ahead and did it for you. This is the FOMC meeting calendar. So we started the year off in January at 0 basis points, which means ZIRP, zero interest rate policy. Then we got our first rate hike in March, if you remember, right? That happened here with 25 basis points. It went from 0 to 25. And then in May, we raised by an additional 50, which means that now we are at 75 basis points or 0.75. So basis points just means below the decimal point. So 25 basis points means 0.25%. And now we've been told that at the next 2 meetings, we're going to be getting 50 basis point hikes. So that means that June and July are pretty much in the bag. And where does that get us to? It gets us to 175 basis points now. It's also important to note that when they do raise in June, there's an asterisk here. So that is a meeting associated with a summary of economic projections. So the summary of economic projections is going to tell us what the Fed currently thinks is very important, meaning what do they think the state of the economy is? And it's important because we got meeting minutes coming out on Wednesday, which I'll go through when I get through the rest of my PowerPoint. So now for a 175, we're awfully close to that 2.4%, which means that they can choose to get close to there, they can pause, or they can start going back down to 25 basis point hikes. They could also do a pause in September and then raise by 50 basis points in November. But for illustrative purposes, I've now shown that for us to get to a neutral rate here by December at 250 basis points, all we have to do is do the 50, which the market has already heard about, and then raise by 25 in September, 25 in November, 25 in December. The challenge is that Jerome Powell even told us that he believes the neutral rate is above 3.6%. So that is where the Fed might start creating the recession, which everyone's scared about. We already have one negative quarter of GDP contraction. All it takes is one more to have a technical recession. So what I think is so important here is that the path to July is very obvious. The path forward is not. So starting in September, we have another asterisk there, which means another meeting associated with the summary of economic projections. If Jerome is truly trying to squash inflation and we keep getting high prints, he's going to have to go beyond the neutral rate. And he's already said he's willing to do that. So this 250, which is currently what the market is pricing in, is going to have to go higher. So again, now let's go back to 2008. Let's go back to 2008. No, I don't have it on this chart either. All right, well, I'm just going to wing it. I'm going to wing it here. So again, we had our falling wedge pattern, which is right here. So we have our falling wedge, right? We got our falling wedge right here. And then once we start the rally, how long does it actually last for? Well, once we actually, am I in the right part here? No, right here. So here's our falling wedge. Let me actually just draw it. Here we go. All right, there's our falling wedge. Here we got it right here. There's our falling wedge. How long do we actually rally for? Let's zoom in really close because I know your eyeballs are probably having a hard time looking at what I'm seeing. All right, there we go. We're at the bottom of the falling wedge. So here we got 1, 2, 3, 4, 5, 6, 7, 8. 8 weeks. How long is that? Oh, that's 2 months. Oh, that's like the period right now. We're sitting here at May 21st to July. Ah, okay. So if now we start hearing that actually we're going to be going by 50 basis points in September, or we need to be above a neutral rate by the end of the year, they're going to have to go by more than 50 basis points. Going 50 for the next two and then 25 at each additional one only gets us to 250. There's only so many meetings during the year. If they want to get to beyond 250, they're going to have to go 50 at these next meetings here, September, November, December. So that is how we could actually lead to this drop. The way that we could actually have that inverse head and shoulders actually lead to a bull break, meaning we don't actually stall out here and go lower, we actually start going higher, would be that they decide to just do this. They decide to just go 25 per meeting. And then again, I believe that that is going to lead to a bigger recession in 2023, which is where, again, we were looking at 2000 versus 2008. I believe that that is how we actually go lower, not higher. So now that you understand the key catalyst that I am looking for, now let's look at the one more thing here. So we're going to look here next at options. And the reason why I'm looking at options is because we had OpEx on Friday, May 20th. And oh boy, were there puts. The move that we got into the close was nice. Don't get me wrong. It was very nice. However, was it related to bulls wanting to put on risk? Or was it more related to burning options? It was related to burning options. We look here at the put side, right? There's 200,000. I'm only looking at the 16, so that means 8 strikes above and below. We've got millions of options that traded on Friday. So getting it back up to 390 means that they burned all of these, right? They burned everything. They were all burnt. We closed at 389.63, which means these guys got back 37 cents when they paid a lot more for those. They got back a couple cents on the dollar. I also want to, so just looking at what happened on Friday, there's a huge amount of volume. And again, if we just look here at the put side, it is gushing, right? hundreds of thousands. We're going to look at the next chains in a moment, but what I want to look at first is going to be the hourly chart on the S&P 500. We've been having an orderly decline with the occasional bear break, right? Bear break here, bear break here, bear break here, bear break here. They were all traps. So if we're forming another trap, we cannot afford to stall out. We have to gap and move higher, right? Push and go higher. So what's so important about this is that we look here at the hourly and we note that we have a volume breakout. The two bars, right? There's two green bars here. I'm going to get to that back in a moment here. So I'm looking at this. I've been mentioning it for, I think, the last week or two. It looks very similar to our weekly chart here where we get a drop in volume and then boop, 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 right? Tons of volume coming in. So if the red volume was an indicator we were going to be going lower, is this green volume an indicator we're going to be going higher? It depends. It depends because what time did these bars actually come in? Normally they come in at the open and the close. There's always going to be a strong open, strong close. That's not been happening anymore. We're into a period where there's less liquidity, remembering that we're going into the quantitative tightening, which means reverse liquidity from the Fed. What time did these actually come through? Wednesday, 4 o'clock. Friday, 4 o'clock. Interesting. So why would these come in on Wednesday and Friday only for the last hour? Because that's when the options expire. They expire on Monday at 4 o'clock, Wednesday at 4 o'clock, and Friday at 4 o'clock. So for me, all this is, hey, we don't want to pay out all those millions of puts people have been buying. Why? Well, stalled out. Well, is this going to stall out too? I don't know. So what I'll be looking for is what happens into the first few days post OpEx. The motivation is going to be very high. And I say that because if the move is going to ultimately be lower, they might try to move it higher to So if they want it, let's just go through the chains and I'll explain my thoughts in a second here. So there's continuation through to Monday, the 23rd. There's puts down to 380 and even 375. But what I'm looking at here is a 385, 382 put spread. They want it back in that correction territory. They want it to close in a bear market. The bulls think we're going to get back up here to maybe 395. So now we have those levels in mind. Let's move forward. Looking out here to Friday. So Friday, we have the same thing. We got 385 to 382 and down to 380. And on the call side, we got 390 to 395. So they're both equally motivated right now. There's tons more open interest for the bears, as we note here on Monday. However, let's now look forward to Friday. So Friday here is going to be the 27th. So Friday the 27th, we have a lot of puts. So we have open interest at 390, open interest at 385, and we also note these areas. If these 385s are going to be in the money on Friday, they're worth $4. That means we're going to be at 381. That's in bear market territory next Friday. All right. So now let's look forward to beyond the 16s, which means what happens beyond the 16s or at areas that are not as likely to pay out, but are that could pay out. So now we note here that on the call side, it's pretty muted. Again, as I've been saying, calls are MIA. There's one strike here that has more than 10,000, only a single one, and it's at 400. There's volume between 390 and 400, but that is it. On the put side, oh boy, we've got 400 to 375. So there's open interest and volume at all these areas. It is so big. And that 375 is really important here. Why? This 375, if they want this back by just by next Friday, there's also continuation through to the June change. So looking at June, it's actually 400 down to 360, which means, again, looking on the call side, there's no stacks here above 10,000. There's not one. There's one at 400 again. But on the put side, it's gushing. From 400, there's 90,000 in OI, to 395, 390, 385, 380, 375, 365, 368, 364, and 360. Oh boy. Oh boy. So again, just going back to Friday here, what's important is that this 375 is worth, let me go forward to the June chain. So this 375 here is worth about, it was worth $10 earlier. So again, when we were at nearly the low of the day, it was worth about $10. Right now it's worth about $7. This is important to me because as we look here at the yearly chart for the S&P, we noted that 365 area is the, let's hide everything here on our yearly chart. That 365 is going to be the 2021 low. So if we are going to be getting a move lower, we already see the motivation. They don't just want this down to 375. They want it down to 360. However, these 375s were worth about $10. So for them to get their money back, we have to now be at last year's low, which now gets us a lot closer to repeating the 2000 pattern, not the 2008. So there we go. There's the options motivation. And all I want to point out here is that, generally speaking, if we are going to get an ultimate move lower, they might attempt to move it higher so that they can scrape these chains. And that is where we can get that continuation, just like we did here, where we go higher, and then ultimately what? Fail. One more way to look at this would be where we actually had the Jerome Powell days that he talked. And let's go back to here. I'm going to snap a screenshot so it's a little bit easier for me to show. There is the Powell talks the first time, right? Powell Trap 1.0. Here we got the Powell Trap 2.0. So Powell Trap 1.0 gets us here to a dead cat bounce, ultimately prints to a lower low, another dead cat bounce, and then another lower low. So we have to pay close attention to this. And the reason why is because when the dead cat bounce started, it wasn't just for a day or two, right? It actually goes in here for a couple of days. Form a bottom, 1, 2, 3, 4 days of up. We've only had 1 day of up. We've engulfed Thursday's bar, which means we could go up into when? Wednesday. All right, cool. Why does that Wednesday matter? I'm going to jump forward here for 1 second, and then I'll come back to my PowerPoint. Wednesday, we got FOMC meeting minutes. We're going to get a very good clue in terms of what the FOMC is thinking, or the Federal Open Market Committee. Yes, sir. All right. Now let's start wrapping this up. I'm realizing it's already been a 30-minute video, and I don't want this to drag on forever. All right. Looking forward to the rest of our story now. So we can note here that we already have fear and greed back into extreme fear here. We've been in the single digits for a while. We're back to 11. Still extreme reading, which means if we're forming a short-term bottom, this is at least telling me that the recipe is set up. Second thing here, looking at the week to date, we now know that, everything's red. Even some of the safest stocks like Walmart and Target are fading lower. The 1 week performance tells us that the pain is concentrated, but some of the safest stocks are now falling, like Apple, like Walmart, like Target. I'm not gonna talk about these in detail. What I want to show instead is going to be the performance year to date, because even though the S&P 500 is not technically closing in that bear market territory, meaning negative 20%, every major trillion-dollar company is now doing that. We're going to now flip to no group, and the biggest blocks, Apple, negative 22, Microsoft, negative 25, Google, negative 24, Amazon, negative 35, Tesla, negative 37, Facebook, negative 42, NVDA, negative 43. So every major company that has a big block is now at least in bear market territory. So this is what we call a stealth bear market, because the underlying holdings of the S&P are actually already in that territory. Last two things here. We talked about a recession. So even before we heard from Target, we had this from Bloomberg telling us that Home Depot stock relative to Walmart. What does this mean? Well, it means that it predicted the drop in 2000, predicted the drop in 2008, predicted the drop in 2020, and it is currently predicting the drop in 2022. So to summarize this, it means that weak earnings get punished in the first quarter. One day reactions post earnings, right? Lowe's, negative 5, Walmart, negative 12, Cisco, negative 15, Etsy, negative 17, Dish, negative 19. I don't know what HCA is. Rost, negative 24, Target, negative 25, Netflix, negative 35. The safest stocks are all falling, or the last dominoes are all falling now. All right, so that is the bulk of what I wanted to present. I will go through some charts in a moment, but let's start going back through the rest of my PowerPoint, probably looking at about a 40-minute video. I got about 5 minutes left. Let me know in the comment section, though, do you prefer the Justin walking you through a process for the first 30 minutes, or do you prefer the PowerPoint? Because I'm happy to do either or. I think that trying to explain my thought process is as valuable as just giving you the notes. Make sure to drop me a comment and let me know. Here are our bear market targets for 2022. Again, sorry, bear market targets, not all necessarily in 2022, and they are updated. So we talked about those 360s. We talked about the 340s and the 330s. So if we are going to ultimately go lower, I think that 330s are definitely not out of the question. Everything is telling me that the levels that I had at the beginning of the year are still in play. We've now checked off 440, 430, 400s, and 380s. Those are all checked off, which is why they're crossed out. Next target would be 364, which we talked about. All right, and remembering that if we are going to dip our toes in, we better make damn sure we know what we're doing. I did actually buy some stocks in the last week. I have some stop loss sets. Stop loss is set, and what this means is that um, a massive drop or a lot of volatility is a trader's paradise. It is an investor's hell. So you have to figure out what you are, an investor or a trader. If you're a trader, there is going to be huge trading ranges. However, the larger move is going to be for investors. That's going to take a little bit longer. Need to have the patience. And instead of trying to call every bottom, let's make sure we have some early warning signs that we're actually going back up higher and that we are looking good. To feed this through to specific levels for the S&P 500, here are my levels for the week. Please note, I'm still bearish. What does that mean? We're in a bear market. My status has been bear for at least a month, but pretty much since the beginning of the year. So we're in a bear market because of everything you've probably been noticing. We need to get back above 412 to get green on the month. So green on the month is the start. And we already walked through the reasons why we could go green on the month. We also have to note that quantitative tightening begins on June 1st. So if we are below 412 next Wednesday as we're opening up the month, that means that we're probably going to have resistance there. Over 428 gets us out of the gets us back to -10. So let's just go back here. I'll show you what I mean. Make sure the levels are making sense to people. So here we go. We got -10, -20, and -30. So those are the areas that we're looking at here. So for us to get back to 428, what it means is that we're now going to be out of correction territory. We're now going to be above the $1.1 trillion in inflows. And because we are currently in a bear market, if we were to now move higher, we're going to be entering a new bull market. So 428 to start. Back over 432, we exit correction territory, and we enter that bull market. That 428 actually comes from our quarterly base. I'm not going to look at that just for time. Maybe I just will. Look at it really fast here. So 428 is, again, the area we have to claim to reclaim a lot of the key zones here on the quarterly chart. In terms of support and resistance, it's right here. I encourage you to pause the slide if you want to read them. It's mostly round numbers for this week. Why bull or bear? Bulls. Well, we've had a whole bunch of value compression. We're now noticing that is feeding through to retailers. Walmart's still more expensive than the bulk of the trillion-dollar companies, which means we have seen a lot of value compression. Is it enough? We'll find out. Bears. Bears are definitely winning. Everything here is check, 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 check. In terms of surprises, I think that we might be hearing from Russia soon in terms of a ceasefire, a withdrawal, I hope. And I think that that could lead to a massive dead cat bounce. So is it going to happen? Will it happen? I don't know. That's why it's a surprise. China as well. China currently still has a lot of lockdowns in their country, and that is roiling the global supply chain. So if they start actually reopening, that could lead to a sustained move higher. And then CPI, again, that's in about 3 weeks. CPI starts coming off the highs. That might mean that the Fed might not have to move as aggressively as we currently have forecasted. What does that mean? 250 by the end of the year might all that we need, right? A couple 50 basis points and then back down to 25s. Key dates, we talked about these. Wednesday is the big day. On Thursday, there is GDP. It's quoted as a preliminary number. I believe it's just a revision. So again, it's notable. I don't think it's going to really move the market if it's a revision. If it's a preliminary one, we already got that. I think it's an error on the investing.com website. We also have initial jobless claims on Thursday, and remembering that Jerome Powell is more focused on the labor market than the stock market. So that initial jobless claims number will be a data point we're paying attention to. And then finally, on the 31st, which will be not this next week coming up, but the following week, we got the close of the month. And that is where that 412 really, really matters. The base case, bears won, and bear market 2022 confirmed. All right, moving forward. So the bulls, what do the bulls got in the tank here? Well, again, we got that potential for a falling wedge, inverse head and shoulders breakout. Is it going to happen? I don't know, but that is the bull case. We also have those IWM and ARK bounces. So we'll look at those when we get to the charts. I just want to keep all the chart review for the final part, but ARK and IWM are both bouncing off the areas we would expect. In terms of the bears, what do the bears got, right? They look cute until they start taking money out of your account. And there's been more than $4 trillion deleted from the equity market or stock market so far this year. Bear market targets, already went through those. This is from about 2-3 weeks ago. So for us to truly form a big bottom, we're going to have to see similar to 2018 and 2020, where we have less than 20% of the S&P 500 above their 200 DMA. I don't know what the number is today. We're probably closer to 20% than we were 2 weeks ago, but we're not quite there yet. So this is where capitulation would come in. And again, they're talking about capitulation. We looked at the psychology chart, and that is what we're watching for. Next, they are also talking about the case for a rolling bear market like 2000 and 2001. So what they're talking about here is the all-time high, one move down, a move higher, a move down, and then the move higher, which means they've, again, Bloomberg here, this is from, I forget her name, I forget right now. She's thinking that we're due for a bounce here. So, right, one move down, so down, up. And so far in 2022, we have down, which means we're due for that bounce, just like I'm looking for with the falling wedge. We also talked about what is driving this this last leg lower. It is it's recession fears, it's inflation fears, and everything else that goes with that. And then we also have the Fed rhetoric. Those Fed meeting minutes coming out on Wednesday are going to be very important because the stock market is getting ahead of the balance sheet runoff. So again, looking back to 2018 here, where the balance sheet actually starts reducing, what happens? Stock market tanks. And the stock market's already been getting ahead of this recent drop. So it could be the one shoe falling before the other. We also talked about recession-like behavior, right? Talked about that already. And then we talked about how there's not actually been enough selling for us to go down into the capitulation area. So I think I might have one more. Let me actually do one thing here. I want to pull up one more of these. So again, let's just read this here. It means that only 3 cents on the dollar has been redeemed. And if we look here at the psychology chart, I think I might have forgotten to talk about this. So when we look here, again, if we're at complacency, we have to cool off for the next big rally. Would you be selling? No. Anxiety is, why am I getting the margin calls? The dip is taking longer than expected. Denial is, my investments are with great companies. They will come back. Panic is, shit, everyone's selling. I need to get out. So when we start to see more money getting redeemed, because right now they're losing, they're red. If they start redeeming, that's where I believe we're getting down into panic. So I'll be watching those outflows really closely. All right, and I believe that the last slide we have here is part of my original bear market thesis when we were looking at the number of months expansion versus where we are now. And the psychology chart that I was looking at is a monthly chart. So we've had roughly 150 months of expansion, 600%, from late 1980s to 2000s, and we have that same thing setting up here. All right, take us home, Justin. Let's look at some charts, and let's wrap it up. So now we're going to look at a couple of charts here, and I'm going to start off by looking at, we're going to look at weekly charts just to keep it a little bit clean, and I'm going to add the volume profile in selectively. I already talked about SPY, so not going to spend too much time here. We are currently in between a supply and demand pocket. I'm actually going to hide these. I don't think it's as helpful here. Moving forward to QQQ. What do we have? Falling. Actually, I'm going to. Here we go. Falling wedge on QQQ. So I'm going to zoom out here to just before the 2020 high, and now we're going to note that there we go. Right there's the supply. There's the demand pocket. It's pretty obvious to me. The dollar is set for a golden cross. It is coming down for its first week because we're hearing the ECB is likely going to be moving forward with rate hikes, and a weak dollar is good for stocks. So the dollar being down by 1% means that we could be getting a 1% bounce on SPY if we can continue to move lower on the dollar. VIX. VIX is still putting in a cup and handle pattern. It is just below 30, which again is going to be that fear gauge. What's also notable here on TNX, or the 10-year Treasury note, is just that it's actually potentially peaked. Again, I don't know for sure, but it's back below 3. And what this is kind of saying is that, hey, the Fed might not be going above that 3%. 2.5 might be all that they get to. Again, we talked about that before, not going to repeat it. Looking here at BTC, BTC is currently in a bearish pattern. It's right on support here, though. And if we're going to bounce, it's got to be soon here. We already have capitulation volume. We have an inside bar. And it is below 30,000, so we do have to get back above there. ETH, again, we're sitting here just below 2,000 as well, so inside bar, capitulation volume, we could be due for a bounce. Let's look at these trillion-dollar companies. So looking here at Apple, let's put the volume profile back in. We note that Apple's not really had elevated volume, and what it's doing is actually entering the area where we have these previous tops, or the green lines, and it's actually entering an area where there is a whole bunch of demand. So Apple might be stabilizing. The concern here is that it did lose its 50 MA, and it did close below last week's low. So we talked about the last dominoes falling. That would be Apple. That would be Tesla. So now we're going to look at Tesla next, and almost exactly the same. Lost its relative high, lost the 50 MA, and closed below last week's low. And where's the big supply zone for Tesla? Oh boy, it's down at roughly 160. So maybe that's why Elon Musk is pulling back from that Twitter deal. And again, he was able to actually sell over $10 billion worth of stock. So he doesn't just have paper anymore. He actually has cash. Looking at Microsoft, I'm just mostly focused on the most recent period here. So we can note here that the median price is here at about 300, and we are in a bearish pattern. We do have a falling wedge, and there is a bunch of supply and demand here. So I just want to go back to just before the 2020 high, and again, we note that the supply and demand pockets are not quite where we are. We're roughly in the middle here, or in no man's land, where there's not a whole bunch of supply or demand here. We have to get down to closer to 200 or about 300 to hit those areas. GOOG. GOOG looks similar to Microsoft. Falling wedge. Interesting. This looks interesting. Gap is filled as well, right? That micro gap here is now filled, so that's a check. Amazon is entering the 2018 high. It's already fallen. It's now inside of a supply zone. Look at all this demand here, right? There's a whole bunch of demand. There's the supply. So if these other stocks are going to ultimately fall to where Amazon is now, we have the template. There's the demand. There's the supply. There's the demand. There's the fade down and the stabilization inside of the demand zone. Tesla, we talked about. Facebook. Facebook looks similar. Right inside of the largest area of demand. And what is it doing? It's stabilizing inside of the this yellow rectangle, which I'm counting from the highs in 2018 to 2020 and the relative lows. Then we got NVDA, psychology chart 101. And again, going back here to the 2020 high, this chart has had an impressive run. It's now coming down to roughly the area where we find all of that supply. And it's got competing signals here, so it's pretty much completed the psychology chart. We have the massive M. We have a falling wedge defined by the blue lines. We are attempting to bounce off the green line or the relative high here, and this could break. All right, finally, let's look at a couple of ETFs. So here we got the Dow. The Dow, again, huge supply zone. That's from this single bar right here. And I think the Dow was actually stabilizing better, but we do have a head and shoulders. And if we're going to move lower, we're bouncing off the top of the supply zone here. Looking at the Russell, like we talked about before, the Russell is stabilizing on the area of previous tops. We got the 2018 high, the 2020 high, and that is where we're trying to form a local bottom. We did print a higher high and a higher low, and that is constructive. Looking at ARK, let's hide the volume profile. This chart is already busy enough. We have now bounced off the area for the psychology chart we were looking at. And the big question is now is, are we going to actually break bull? We have a tight inside bar, and for the dead cat bounce, we could go as high as roughly 52. Pattern is now complete for the psychology chart as well. I want to just look at one or two others here. I want to look at XLF, and then I believe we're going to wrap up. Here we go. Last one here. Let's add in the volume profile. Here we are. This looks just like the Dow. So if the Dow and the financials can stabilize, meaning bouncing off of the supply zone, not actually entering it, that can mean that maybe we're going to get that rally on the S&P, and financials being down and TNX also being down signals that maybe we don't really believe the Fed that they're going to be going as high as we need to. Maybe 2.5 is all we're going to get to. All right, so that is it. This is a very long video. I thank you for watching, and if you want to know more about where my original thoughts for the bear market of 2022 came from, we will queue up a video here which walks you through. I believe this is a video from January, which is going to tell you my original bear market thesis. I thank you for watching. I would really appreciate a thumbs up, and drop me a comment if you're enjoying the content and have not subscribed yet. please subscribe. We put out videos nearly every single day. Thank you for watching, and I look forward to seeing you on the next video.